Welcome. Today, we are diving into a really dramatic theory about what's happening in the global silver market. The source material we're breaking down argues that a series of events in China could be signaling a fundamental break in how silver is priced and traded across the entire world. So, let's get right into it.
The analysis we're examining really frames the whole situation with this powerful quote. The idea here is that what's happening isn't just some temporary glitch in the system. No, it's a seismic shift. This quote perfectly captures the urgency of what we're about to explore.
And here's the core of it. On December 27, 2025, the Shanghai silver market was reportedly trading at $81.99 an ounce. Meanwhile, over in New York, the COMEX futures market was down at $79.54. That price difference is the central mystery. The source argues this isn't a simple case where traders can just buy low and sell high. It's actually a sign that the physical market and the paper market are fundamentally decoupled.
To really get our heads around this complex argument, we're going to walk through it in 5 steps. First, we'll look at this tale of two diverging markets. Then we'll get into the theory of what's being called China's silver wall. Third, we'll explore this clash between paper contracts and actual physical metal. After that, we'll talk about the argument that this might be signaling a new resource war. And finally, we'll look at what the source predicts could happen next.
Okay, so let's start at the beginning. What kicked this whole thing off? Well, according to the source, the trigger was a totally unprecedented wave of physical silver being pulled out of vaults in Shanghai. This is what allegedly set the stage for this massive price difference between the East and the West.
So in Shanghai, the price reportedly hit $81.99 an ounce. And the source material really hammers this point home. This isn't some speculative paper price. This is the cost to get your hands on actual physical silver.
But then you look at the COMEX futures price in New York, and it was more than $2 lower. That's a gap of $2.45. And the core argument here is that this isn't a failure of traders to close the gap. It's a failure of the system itself. It's a signal that the Western paper prices just don't reflect the reality of securing physical metal anymore.
So the big question is, how did this happen? Well, according to this analysis, this price dislocation wasn't some random market fluke. It was the result of a very deliberate strategic policy by China, in effect creating what the source is calling a silver wall.
And this theory comes with a very specific timeline. It all starts back in June of 2025, with everything looking pretty normal. But by late September, Chinese manufacturers reportedly started buying in really unusual patterns. This just picked up speed through October, and then, on November 12th, the Chinese government made it official. They announced a new licensing system that would severely restrict silver exports starting January 1st, 2026.
Now, why is this policy such a big deal? It all comes down to one word: refining. You see, the source claims China controls a massive 60 to 70% of all global silver refining capacity. That basically makes them the gatekeeper for the world's supply of investment-grade silver.
So as you can imagine, the moment this export restriction was announced, it supposedly kicked off an industrial scramble. The analysis points to major tech companies, think Samsung and Tesla, who absolutely depend on silver for their products, suddenly facing a potential supply cutoff. These big industrial users reportedly started buying up any and all available physical metal at any price just to avoid shutting down production.
All right, so this mad dash for physical silver in the East, that brings us to the next piece of the puzzle: the consequences for Western financial markets, especially the COMEX. This is where we see the clash between the value of a paper promise and the value of a physical bar of silver.
Now, to really understand the claim that the Western market is fragile, we need to quickly define 2 key terms for how the COMEX counts its inventory. Registered silver is metal that's actually available to be delivered if you cash in a futures contract. Eligible silver, on the other hand, is just being stored in the vault for a customer. It is not for sale, and that distinction, it's absolutely crucial.
This visual right here really shows you the core of the problem, according to the source. While the total amount of silver sitting in the vaults, that eligible stock, looks pretty high, the amount that's actually for sale, the registered inventory, has been shrinking at an alarming rate.
And the source puts a pretty shocking number on that decline: a 73% collapse in the COMEX registered inventory in just 5 years. This is presented as the smoking gun, proof that the physical buffer back in the entire paper market has been hollowed out.
So the argument is then made that this time is different. Unlike the speculator-driven rally back in 1980 or the paper demand rally in 2011, the source claims this 2025 event is being driven by a genuine industrial shortage. That demand is described as inelastic, which just means big industrial users have to buy silver, no matter the price. And that makes this situation fundamentally different from anything we've seen before.
Okay, so this is where we zoom out to the bigger picture. The analysis connects all these market mechanics to something much, much bigger, a broader geopolitical competition, framing China's moves as a major play in a new global resource war.
And why does it matter so much? Because silver is absolutely indispensable. It's a critical component in all the defining technologies of our time: solar panels, electric vehicles, AI data centers, and advanced military electronics. And for most of these things, there is no easy substitute.
All of this industrial demand has allegedly created a massive supply imbalance. The source cites a persistent annual deficit of 245 million ounces. That means every single year, global demand is far outstripping the amount of silver being produced by mines.
And this all leads to the ultimate geopolitical thesis of the source material. The argument is that China's move isn't just about money. It's about securing the one material that is absolutely required for the global green energy transition. By doing that, they could gain strategic control over the future of energy itself.
So, where does all of this leave us? Well, the final part of this analysis lays out a series of really bold predictions for what it believes is going to happen in the immediate future, as all these forces come to a head on the world stage.
The source predicts a very specific domino effect. First, panic buying kicks off as soon as Asian markets open. This forces traders who are betting against silver, the short sellers, to buy back their positions, which just adds more fuel to the rally. The price gap between the East and West then becomes undeniable, and the source claims price discovery itself, how the world decides the price of silver, will permanently shift from New York to Shanghai.
And that leaves us with this final, central question posed by the analysis. It is the core tension of this entire theory. What happens when the price of a paper derivative becomes completely detached from the cost of securing the actual physical commodity? It's a question with profound implications for markets far beyond just silver.